Welcome to Closing Trades, right here in 18 hour with me, Aisha Faridi and Anisha Jain as well. Joining in on the show, we are maintaining that 19,100 print largely, or rather for the better part of today's trading session. Yes, we started off flat, dipped into the red about 0.5%, and then from there we've been pretty okay. As we speak, we are making a dash towards the green. 19,100 is where we're currently at. Reliance actually is the single-handed stock which is providing that apt cushion to the index. Post its inline set of numbers and retail being a beat, you've seen that stock made a decent move from the word go, and it's managed to build on to that. Roughly about 2% is the kind of gain that the stock has been standing on for the better part of today's trading session. Actually, had it not been for Reliance, the start of the trading day could have been quite choppy, because that's the only conclusive winner today, along with, of course, BPCL, which is also seeing gains of over 4% right now. The lag sector today has got to be autos, and pretty much across the board. Everything from Tata Motors to Maruti, Bajaj Auto, M&M. All of these names are the beleaguered ones. The breadth of the market too has recovered, so that's a good sign. And again, Anisha, the recovery is in line with the rest of the globe. As I see, Europe as well has made a decent start.
Yeah, Europe has made a decent start, but that's coming after that sharp decline that we had seen last week across the global markets. Indian markets, of course, did not fare much differently. We also saw a decline of almost 2.5%. But what about the way forward? That's the big question, and we'll discuss that with our technical experts in the show. So let's welcome them on board as well to get a sense as to what's happening with the market. But before that, let us run you through the top newsmakers that we have at this point of time. KPIT Tech is one stock that saw a big reaction to its earnings. So a 9% growth on a quarter-on-quarter basis definitely deserves a thumbs up. But what came in as a surprise was that big guidance upgrade coming in from 27 to 30% kind of growth. They have increased it to 37% growth in FY24. So a solid jump in the guidance for revenue, and margin guidance too has been upgraded, and we are seeing the reaction on the stock. Anup Engineering also delivered a good set of numbers. The consolidated revenue was up 39% on a year-on-year basis. The profitability also managed to jump 70%, and look at the reaction on that stock, 14% higher. Ditto can be said for Greenlam Industries as well. The numbers actually came over the weekend, but that stock has been riding quite well for itself, 9% higher. Revenue was up a 16%, but it was profitability that fared much better with that 42% growth. Talking about some more earnings candidate then, M&M Financial, it was a weak set of numbers. The commentary was a bit sluggish, the net interest margins contracted, and that's the reason you are seeing a slide of almost 12%. In fact, since we are talking about some of these earnings, let's play the bite that we got from the management of M&M Financial as well, because they talked about how going forward it's going to be a bit more sluggish, elevated cost concerns are there. IDFC First Bank also talked about the return on asset and the target to reach towards that 1.25% mark. Plus, of course, we also had IHCL talking about their blockbuster performance. It was actually a good set coming in. The margin performance was decent. There was some pressure from the international geographies, but it's the outlook which continues to be strong. Let's listen in to all those managements.
We have used comprehensive asset management to reposition our iconic assets, not just only for being iconic, but to create more and more profitability on a per square foot basis. November, if it holds on like this, and October is very strong, then I do believe that we are in for a very positive Q3. And that would come, if that was to come, would come over and above the guidance that we have given of opening 2 hotels every month. So that is like opening 70 plus hotels over the next 3 years.
The way we think about it to looking ahead, we think that a loan growth of about 24-25% is what we guide for. We think that's very much achievable even for this year. And profit and deposits, by the way, is as well as a foundation for any bank, because that's the raw material. The really good news for a bank, that this raw material that's growing thick and strong for the bank, that's up like 44%. So I think this is very much sustainable for the rest of the year. If not 44%, let me say 40% is looking, the route is very clear to us. We are well capitalized at 20%. That's very important. Our capital adequacy is running at 18%. So we are well set.
No, so it's not cautiousness, right? It's just that the base is much higher. If you look at the first quarter and the second quarter of last year, and then on that base, you grow at 27%. But last year, even the third and the fourth quarter were big quarters. So therefore, to register a growth on that is what we are saying, that we would be able to definitely grow at about 20%. Once more, see in the next season, the pickup does happen. And it's also infrastructure story back. So once the infrastructure story, which we are seeing, is at its best now, you will start seeing the commercial tractor purchases will begin to happen. On an overall disbursement front, as I said, we are gaining market share in some of the product, and also across the country, we see traction doing well.
Okay, on that note, let's welcome on board our chartists and our fundamental experts and figure out where the market is headed next. We've got Manoj Muralidharan joining in right now on the show. And we've also got Naresh Mirani, as always. Hi, both of you. Good to have you on the show. Naresh, let me come to you first. A smart rebound, aligning ourselves with the rest of the globe, and especially coming in from those oversold levels last week. Does it look sustainable?
So as of now, we are finding supports around this 18,850, 18,900 mark. Overall, the bounce should face resistance around the 19,250 to 19,300 mark. So this could have some more legs. Closer to 19,250 would be a tough area. We've come very close to the 19,100 cross today. So overall, a bounce back. Too early to say whether we've found a bottom or changed trends. But as of now, the bounce back is with support of the broader markets also. And the mid cap and the small cap indices did not see a similar hit. We did not see any of them testing the 200-day moving average, whereas the Nifty as well as the Bank Nifty went all the way to 200-day. Bank Nifty went below that also. So overall, looks like a bounce which could go towards 19,200, 250. And then maybe after that, again, take a fresh look.
Manoj, I want to get you in on the conversation as well, and specifically on Reliance, the kind of contribution it's had from the word go today for the index because of its weightage. You think Reliance can scale up higher than what it is today, reacting to its numbers, which came by post-markets on Friday? Manoj? Okay, we'll just get to Manoj in just a second. Naresh, what's your take? Where does Reliance head from 2,300 plus now?
So Reliance has made a decent move today. The last top, previous week was closer to 2,350 to 2,365 levels. So that should be a tough area for the stock. So another 30, 40 points higher, and then maybe we should get a lot of resistance around that area. It's only when we cross 2,370, we get a reversal in trend. And that also would be needed to confirm a trend reversal in the index as well. So watching out for that 2,350, 2,370 mark. For now, I would expect a bounce towards 2,350, 2,370.
Taken, that's a take on Reliance Industries. But Manoj, wanted your word regarding Vodafone Idea. That's trending higher by 7%. And of course, Petronet LNG is seeing that reaction of that capex announcement of around 20,000 crores. So the stock has taken it on the chin post its earnings. But what's the chart check telling you?
Yeah, thank you. So ideally, we would not really, we would refrain from the price movement that you're seeing, especially on stocks like a Vodafone Idea. See, the concept here that we understand, at least on the index, is the FI desk were a good 90% odd short on the index, and every time they have done that, the put option pricing does not really fetch them good money. So if you see the volatility index also for the market was at 12.5%, which is almost down now to 10.8. So it is the put selling which is giving you more money than the call buying. So the index clearly says that we might be into a consolidation with a 150 more points on the upside, somewhere close to 19,300 to 400. So the major large caps or stocks which would be benefiting would be from them. We would not really volunteer or advocate buying a Vodafone Idea at this point of time. Couple of stocks like a Cipla and GNFC where we are seeing good long build up, that is where we would recommend buying that. If it is for Cipla, even the stock has a potential of almost 1240 with a stop loss of around 1180 on that. And second would be GNFC, also is a good stock where we have seen a good rollover which happened from October to the new series of November. So at least a 4% move is what we are expecting on the stock as well.
The other sector, while we've discussed, of course, the major contributor, Reliance, but oil and gas at large has been a strong show today. So BPCL, for instance, is scaling higher by about 4.25%. There's MGL as well, which is standing up by about 3.5%. ONGC as well, looking pretty strong. Naresh, what's the trend that you foresee now on some of the other gas and, refiner plays?
So ONGC looks the most interesting one. because this time around with the market correction, it did not break the recent swing lows. So if you look at the month of September, we made a low around 180. In October, we made a low around 180, 181 levels. We reversed in the last two sessions. As of now, the stock has crossed the last almost a month high. The previous high for the stock is around 190.92 in September. And going back all the way to February 2022, when crude hit a 130 mark on Brent with Russia-Ukraine prices, that time also the stock had topped around 190.95. So first indication of relative strength, if it can sustain 190.92, that would be a multi-year breakout as well. So the topmost on radar to be watched out for is ONGC, and if it sustains 190.92, it could be a bigger breakout. So out of oil and gas, I would be looking out for ONGC. Next would be GAIL India, which around 117 to 120 is a support zone. So good entry point here with a strict stop loss at 115 on that one.
Point taken. So that's the other one from the oil and gas space that's looking quite strong. But real estate, that's also building on to gains. Of course, Chris Wood was talking about how there could be a repeat of 2002 to 2009 cycle that we had seen. And we might be in the second or third year as far as that rally is concerned. Manoj, what's your take on the real estate stocks? And if you like any name from there, a DLF or Godrej Properties?
Yeah. So the concept that we understand here is, niche sectors like a metal or a real estate, they have a market-wide positioning in the entire derivative segment, which is usually less. So we compare a month-on-month positioning, and at least stock specific, we believe that Oberoi Realty would top the pack, and there is a potential for at least a good 4 to 6% move. The stock has seen good delivery-based buying as well, and the rollovers has been prudent and better into the November series. So at least a 1150 to 1160 as a target with a stop loss close to 1100. Even now, I guess the stock is around 1150. It can be bought at this level also with a stop loss of 1100. A good 1160 to 68 should be the short term target on the stock.
Taken. So those are some of the real estate bets coming in. But time now to slip into a very short break with the news that the market is holding up okay, close to the highest point of the trading session. But we'll tell you how the last 45 minutes of the trading session pan out when we come back.
Back with closing trades right here in 80 now, and a near 1% recovery is what you've seen from the session lows. That's of course UPL right now. We will just get those numbers in just a short second from now. There's of course Idea, BPCL, Reliance, ONGC. It's really oil and gas which has been supporting the index today. There you go, UPL and a loss of 189 crore rupees versus the PAT that our estimates were penciling, and I'm sure there is a one-time, component which would have dragged. Is it, Anisha?
No, it looks like it's actually a top-down miss because we were expecting a number of almost 10,800 crores. It's coming at around 10,200 crores, sub that number actually, and that's the reason there's a miss. Of course, the share of losses from the joint venture and associates, that has shot up. That's putting further pressure on the bottom line because out of that 390 crore loss figure that you're witnessing, almost a 200 crore number is coming in as the loss contribution from its associates and subsidiaries, and that's telling you that perhaps the performance of some of the subsidiaries has been subpar, and that's the reason you're seeing a sharp reaction on the stock as well. It's down now 3%, so it's a miss on the top line front with the revenue coming in at 10,170 crores versus expectation of 10,835. As a result of that, margin has been a miss, and then this pressure coming in from the subsidiary performance, which has actually completely eroded the bottom line, and we are staring at a loss this time of around 189 crores, rather 293 crores at the net profit level versus the expectation of the profits that we had seen earlier. Usually UPL also comes out with its presentation that provides an update on the guidance, so we'll wait back for further details on that. But as of now, it doesn't look too good, and of course the stock reaction is in accordance with that. We also have Rupesh Patel, the Senior Fund Manager, Equity Investments, Nippon India Mutual Fund, joining us on the show. Let's begin by discussing the chemicals and agrochemical industry itself, because the numbers haven't been that impressive. Yes, that entire China plus one theme, Europe plus one theme was the reason why we had seen these massive capex announcements, but looks like it's not happening at that swifter pace. There are a bit of a roadblocks that seem to be there.
Sure. So actually, if we look at the sector, then some of it, the gains which we saw in last few years was on account of capacities not available in China or some kind of disruption being there, and as a result, some Indian companies saw pickup in volume as well as the price uptick in their products, and as a result, we saw companies reporting very strong financial numbers as well. Now, some of that bit is reversing. So companies which have some kind of advantage in terms of the kind of chemistry they deal with or the kind of customer clients they have, I think apart from that, you will see some kind of I would say disruption in the sense that commodity players will find it challenging in terms of financial performance. At the same time, I think valuations had also run up to some extent, and largely they were factoring in. There was a lot of extrapolation of those financial numbers, and as a result, we feel that it was a sector which was ripe for correction. So, as a portfolio, I mean, we have underweight stance on the sector because of rich valuation and some headwinds expected going ahead. And yeah, that's our position.
I think the only solace is that, post FMC cutting their guidance, a large part of the correction in the chemicals sector has already played out. So what you're seeing, of course, on UPL is a large knee-jerk reaction because one didn't anticipate these kind of losses. But maybe it should settle down soon. The other one, of course, which has been buzzing and holding out well is Reliance. It's now climbed up to 23.28 on the futures. That stock is higher by a good 2.5%. In fact, let me take it across to you, Lisa as well, and get in a word on UPL before we move forward and discuss other sectors with Rupesh. Lisa, what went so wrong on UPL's performance?
So Aisha, anyway, it was expected that UPL will report weak numbers, but it came weaker, much weaker than what the street estimated. The revenue, it came in at around 10,170 crore versus 10,835 crore, what ET Now poll estimated, 6% below the street estimates. EBITDA came at around 1,325, much below 1,988, which was estimated by us. Even we had anticipated, and even the street had anticipated a profit of around 300 crore, but it came at a loss of around 189 crore, mainly on tax purposes. And even the EBITDA margin, that was at around 13% versus 19% seen last year. So weak results was expected anyways on the back of price correction in generic portfolio. And even the destocking issue also continues. Volume of offtake was expected to be low, and especially the regions other than LATAM as well as ex-Brazil region, that was expected to deliver better. So even finance cost, that has caused an impact on the EBITDA because of the higher interest rate. So management has been also guiding on the net debt reduction. So we have to see whether this happens or no. And revenue growth guidance, last time it was cut from 6 to 10% to 1 to 5% last quarter. So we have to see whether this quarter also is there any guidance cut. Even the EBITDA growth guidance also from 8 to 12%, it was cut to 3.2, 3 to 7%. The investor presentation is not yet out, and we have to wait for the presentation to be out to give an update on the guidance as well. So that's on UPL. As we can see, the stock is down and about today in trade on the back of weak set of results coming in.
Okay, I guess that disappointment quite playing out, and a jump up as well from those lows actually on UPL. Let's see which way that stock actually settles down. But Rupesh, just, given the kind of correction that we've seen play out last week and, the way we've rebounded from there, just wanted to understand what's the tactical call on the market right now, and especially the kind of pounding that the mid and small caps have taken.
Sure. Actually, if we see markets, yes, last few months markets have done well, and within
and kind of reconnect that line. Just got the press release from UPL also out, and they are saying that liquidation of high-cost inventory, higher than usual sales returns and rebates to support channel partners impacted the contribution margin. Adjusting for this temporary impact, the margins in the first half of the year would actually be higher by 300 basis points as compared to last year. They're also talking about how seeds business has continued its growth momentum. I'm also, just watching out for the commentary coming in from Mike Frank, who's the CEO of the consolidated business, and He says that given the backdrop, the distributors actually prioritize destocking and only focus on purchases at lower price to bring down the average inventory cost, and especially there was a significant impact of destocking in US and Brazil, and that's the reason we have seen a weak performance. Going forward, he says that they're optimistic of the progressively improved performance in the second half of the year as key geographies like North America, LATAM and Europe enter the major cropping season, and the inventory levels have also come off, so that's something which is giving the optimism. On the pricing front, he says that most of the prices, the patent molecule prices seem to have bottomed out and they are stabilizing going forward. So they are expecting further improvement in the business in the second half of the year. Rupesh is back with us. Rupesh, just continue the point that you are making on the markets, the tactical trade and your positioning right now. Rupesh, could you hear us? The question on the markets, what's your overall... Okay, so I think there is some technical issue as far as that is concerned. But we should flash some of these commentaries coming in from the UPL management, and that's the reason we are seeing a rebound, because they're talking about the second half of the year being better. They're talking about the inventory, destocking happening, and that seems to have bottomed out. Plus the pricing as far as the patent molecules are concerned, that's also stabilizing, and the result is that the stock price is also stabilizing as we speak. Of course, there's a call later in the evening wherein the analysts will be posing all these questions as well, and we'll figure out more on that. But let me get back to Naresh as well. Naresh, on the stock of UPL, what does the chart check suggest? Would you recommend any trade right now?
So there is no trade. Actually, the stock has broken down quite a bit over the last few weeks. The stock came back to 630, could not make that breakout, and for the last 7 sessions, it has been closing negatively. It has broken multi-year lows as well. So the last, say the stock was around this 550, 600 mark last in 2021. So broken that lows as well. The next support only comes closer to that 525, 530 mark. Came very close to it right now and bouncing back. So not looking at a short trade here, but not looking at a long as well, given the fall already. I would expect a lot of resistance around 575, 580. So if it comes closer to those levels, maybe that could be a shorting area.
Right, okay. Adani Green Energy just came out with their numbers, and the revenue from power supply has seen a significant jump up of 80% on year-on-year basis. The EBITDA from power supply up 62%, and margins stand at 91.3%. In fact, as we slip into this break, let's hear it out from Amit Singh as well, the CEO.
Renewables remain the cornerstone of the global energy transition. Earlier this year, India charted a goal of tendering 50 gigawatt every year to achieve the 500 gigawatt non-fossil fuel capacity by 2030. A coordinated policy action in this direction, along with a wider industry effort, is much needed. In line with India's decarbonization goals, we remain committed to deliver in excess of 45 gigawatt by 2030. Adani Green continues to have the largest operating renewable portfolio in India, with 8.4 gigawatt capacity. We're ramping up our execution capabilities as we prepare for our next phase of growth. AGL is working extensively on our next milestone of developing the largest RE cluster in the world in Khavda in Gujarat. Coming to the operational and financial performance for H1 Financial 24, I'm delighted to share that we have continued to deliver strong performance across financial and operational metrics, with a reduction in leverage. To share a quick performance snapshot, the sale of energy has increased by 78% year-on-year to 11,766 million units as a result of strong capacity addition and improved CUF across solar, wind, and hybrid portfolio. Revenue from power supply has increased by 66% year-on-year to rupees 4,029 crores. EBITDA from power supply has increased by 58% to rupees 3,775 crore, with an industry-leading EBITDA margin of 92%. As a result, cash profit has increased by 63% to rupees 2,082 crore. The run rate EBITDA now stands at a strong rupees 7,645 crore, with a net debt to run rate EBITDA at 4.99x as of September 2023. This is compared to 5.9x of last year. While delivering the outperforming results, we've also made significant progress on our ESG commitments. As we work towards our capacity addition in Khavda, we have deployed a workforce of 5,000 plus people. These have been extensively hired locally, and we are investing to upskill their talent and develop them through our comprehensive program. Khavda, as you know, is a remote location in India, and within a very short time frame, we've also created an entire social ecosystem for our employees and contractor workers to live and work in a harmonious fashion. As we go forward, we are electing to also use robotic cleaning to significantly reduce water usage to almost zero across all our plants. We continue to follow the highest governance standards. This has been recently reflected in MSCI's ESG rating update, where AGL's corporate governance score has been upgraded to 7.4. This is the highest scoring range relative to global peers.
Well, the optimism that we are seeing in the European markets are actually trickling down to the US pre-market rates as well. The Dow futures for now is suggesting an uptick of almost 180 points, and the Nasdaq futures too are comfortably showing a gain of 0.8%, and that after that big correction that we saw last week. Of course, this week is going to be all about that Fed meeting. 98% people are already expecting that it's going to be status quo, but it's the commentary which will be important. Talk about commentary that's coming in from UPL. They have yet again downgraded their guidance. They are now talking about a flat performance when it comes to the revenue this time. Earlier they were talking about at least a 1 to 5% growth, so that has been downgraded. And the other thing is EBITDA growth. Earlier they were expecting a 3 to 7% growth. Now they're expecting a possible decline because they're talking about how EBITDA could either be flat or a decline of almost 5% could be seen. So that's the reason you're seeing those jagged edges as far as UPL stock is concerned. But we are now joined by Samit Chavan as well as Deepak Shenoy to talk to us about the markets, and Naresh is of course still with us. Deepak, let me begin by asking you, the moves that we saw last week in the market, what do you make of that? And now after the correction, do mid caps and small caps look better placed?
To be honest, I think mid caps are better placed than small caps. We're just looking at earnings growth, just plain earnings growth from whatever companies have announced results so far. We've seen that mid caps are upwards of 25 or 26% median earnings growth in whatever has been announced so far. Nifty companies, I think, is about 19+%, and small caps have been lagging. Margins have been compressed, so they're seeing only about 13 to 14%. That's the small cap 250, the results, whatever have been announced so far. So I think mid caps have a more better position from a perspective of fundamentals. I think pricing wise, we've seen prices decline on both the small and mid cap side, both roughly the same 6-5% in this month so far. So I would believe that in general, the correction has given us a better time to get into mid caps. I think people had become more small cap focused. So shift to mid caps, especially after results, might be useful. But let more results come in. I think corrections are good. This is not even a correction. It's only 5% off the top. You would typically call something at least 10% off the top to be a correction. So even the small caps haven't corrected 10%. So to be fair, I think more has to come before we name it that.
Right. Deepak, hi, afternoon. Just wanted to understand, how did you read into Reliance's numbers? While the numbers are largely in line and clearly retail is the it business for them, the most valued as per the SOTP. But, a part of the market also believes that, the main issues remain high capital expenditure, negative cash flows, subdued return ratios, the debt levels continuing at a very high pace, and that's going to, keep the stock abated and make a case for re-rating extremely difficult. What do you think?
So I think each of these reasons will have to be answered differently, Aisha. I think, for instance, debt, the net debt is about 120 odd thousand crores. It hasn't changed much. The balance sheet size is of the order of, I think, what, 800,000 crores. So, or rather their assets. So, sorry, their equity. So the debt to equity is negligible if you consider the cash. There is more emphasis on capex that has happened because they've been in this acquisition spree on retail. They've been investing more in a bunch of other things, including 5G. They've talked about getting low level satellite level communication so that last mile and tower density may also not be an issue in the future. So there is, I think, a lot of investments going on. We own the company, so therefore obviously biased. But I think the margins this time and the growth this time was actually quite spectacular. I don't expect it to be this high. About 30% on earnings is a relatively high amount for Reliance. But I do think that the sum of the parts, once they demerge all of the entities, will actually be higher than what Reliance is right now. And to be fair, this time one of the best performers has been the oil to consumer business, which has rebounded quite spectacularly. So apart from retail and the 10% only in Geo, which is possibly intermediate change. But I would still say that the whole company itself is more valuable if you looked at its individual pieces than if you looked at it as a whole right now. Markets will not value this company as a whole just as much as it will value individual pieces.
Sure. So how much upside are you ascribing to Reliance, say, in the next 1 year? It's currently at 23.20 thereabouts.
I don't think it'll happen much in the next 1 year. To be fair, I think it'll take some time for a company like a behemoth like Reliance to demerge and list its subsidiaries or list its individual parts. Will take some time. I think if you look at a 5-year kind of a number, you should be seeing this company at the sum of the parts valuation at say double its market cap in 5 years. That's the minimum you'd expect of an equity return in any case. But I think it's more than that. So I believe here that the valuation will come through as the individual businesses shine. They've already moved from what was an oil company to what is now a retail and telecom company in less than a decade. So I would say big futures ahead, but we've got to wait for that future to be realized. I can't predict it in advance. It is definitely not the next 1 year.
We'll give you the report when we go on November 1st, Anisha and I, to that new luxury mall that they are set to open here in Mumbai. Okay, but anyway, that aside, let's just quickly take it across to Sharad as well, find out what the dealing room chatter is like. Sharad?
Well, yes, in focus, we are having SML Isuzu, and what we are hearing from the dealers is buying is being seen in the HNI as well as the DI segments. Now, you look at the volumes also, that has been strong, coming in at almost 5 times its 20-day average. And we did check the charts, and where we saw a multi-year breakout happening on a 7-year basis. Also, ex-Flipkart founder Sachin Bansal is having 17% stake in the company, and going ahead, the numbers of Q2 will be coming out on November 3, and it's expected that the October sales will also be robust as seen in the month of September as well. Importantly, also the strong demand is coming in the CV segment, and the CV industry is expected to grow almost 7 to 10%. Now, this is being aided by a strong replacement demand, the thrust by the government on infra spending, and also lastly the boom coming in the e-commerce sector.
Okay, thanks Sharad for that. But Deepak, what about the primary market action? Have you tracked the Mamaearth's IPO? What do you make of the valuation?
The valuation is a little bit higher than I would have expected. I mean, I know that we've heard of valuations higher than this, but in general, this is a company that's actually shown a profit in the last quarter of about 24 crores. That's the June quarter. But because it's the quarter before the IPO, you kind of expect that some profits will turn up. But before that, it's largely been loss making, and their cost of advertising and is a relative portion of how much they make tends to be relatively high so it's not really a mature FMCG company, and it does have the B Blunt salon, so it has an offline component that is not as let us say does not have the operating leverage of a pure FMCG company. I think interesting company that way in terms of having a domestic brand in this space, domestically owned and run. So for the most part, we've had most brands imported, getting the international structure, but very few brands have come out from the ground up. That way it's good, but I think valuations are rich. I'd wait for post IPO for things to settle down before, and there is of course the overhang of the fact that any capital funds may want to sell out their stake because they're not allowed to hold public companies. They're only allowed to hold private companies. So after about 6 months, you'll see this sudden selling interest emerge from and create issues with the stock price. So we just wait a little bit, wait for them to announce results after the IPO to see how sustainable these profits are.
Point taken. Not sure actually if you've heard of this very often, at least in this earnings season, but there was a guidance upgrade that happened from one of the IT companies, and the guidance upgrade wasn't just a percent or two from 27 to 30%, which was the guidance earlier. KPIT Tech has actually increased the guidance to 37%. Wow. So they're talking about a growth of 37% in a year when
just this quarter, I think in previous historically as well, there's never been such an upgrade, has it?
No, not to this level of 10%, and not that the company has announced an acquisition right now that you have an inorganic bump up coming in. The inorganic acquisition also happened a couple of quarters ago. So nonetheless, they're expecting some big ramp up clearly, and that's the reason they have upgraded this guidance. Margin guidance too has, of course, accordingly been upgraded to 20% plus now. Deepak, what do you make of this? KPIT, of course, is one of those outliers when it comes to the IT industry because of its focus towards that transportation, vertical. But do you think it's priced in because the stock is definitely not cheap?
Oh yeah, I think at 75 times earnings, not cheap. So I think you'd expect it to grow 30% at least. But I think the idea over here has been that as the auto EV drive takes off worldwide, there'll be a lot more demand for their service and product ecosystem, which I think they are quite well entrenched in, and it's very difficult for players to penetrate into the space as easily from the outside. It's a very traditional industry. They tend to work with the same suppliers over long periods of time. So that way, I think revenues seem to be reasonably protected, but their growth number is astounding. Like you said, it's 37%. That they've talked about. They don't have the margins of a product company yet. They're just less than 19, just about 19% so far. So if they improve margins, obviously I think growth will come in on the EPS level as well. So waiting to see how that happens, but little too rich for my liking in terms of valuations. Maybe we'll look at it. Maybe we're wrong. The company could be just worth this much or more. But I haven't got that sense from so we don't own any KPITs in our fundamental portfolios at least.
Okay. Well, there are a lot of other stocks as well, but which are going to be in focus. Not just KPIT, which of course today is climbing up higher on account of that guidance uptake. There's DLF, MGL, JNFC, BPCL, and Idea. They're all holding up very, very smartly in trade. But let's also talk about what to expect from L&T too. We've got Lisa waiting by. L&T, remember, is set to report its numbers tomorrow. Lisa, what do we expect?
Well, L&T is expected to report good set of numbers. Revenue is expected to grow 20% on year-on-year basis. Even EBITDA is supposed to be seen good growth of around 10% on year-on-year basis. However, margin is expected to see some slight bit of pressure, and that is because of more orders coming in from the low margin orders, as well as normalization of margins in the defense as well as the hydrocarbon segment. So that was on the parameters revenue EBITDA. But moving on onto the order inflow is expected to see a growth of around 30% on year-on-year basis. And the factors to keep a watch on would be the ordering momentum, especially from the Middle East region, the competition intensity, how will it impact the margin, the progress on the divestment for the non-core business, that is Hyderabad Metro as well as Nabha Power, as well as the management commentary on the new business segments, that is solar hydrogen. Well, last time the management had given a guidance of revenue growth in the range of 12 to 15% and order inflow growth of around 10 to 12%, while the core margin is expected to be at around 9%. So we have to see whether the guidance remains intact from the management commentary. So that's largely what's being picturized around L&T earnings, which is expected to report tomorrow.
About the expectation as far as L&T goes, but Deepak, that's been the sense, right, ahead of the election year, and Given that entire capex theme and infrastructure theme, do you think L&T has more legs? It's already almost 3,000 bucks.
Yes, I think it does. In fact, we own it, so it's still at 18 times consolidated earnings. This time, the earnings of the IT subsidiaries have been a little disappointing in terms of growth. LTI Mindtree is more or less flat. LTTS is less than, I think, 10 or 11%. The L&T Finance Holdings has done 40% earnings growth, so that's reasonable. L&T standalone, I think, will do, standalone being the non-listed businesses. They should fairly do decently because of the order flow that's come in. Order flow expectations are high. In general, even without the elections, our expenditure on infra has increased quite dramatically. So I would expect that this, the standalone revival, the revival of the core engineering businesses is going to drive the stock price upwards. Plus, they've done a buyback, so the number of shares would have come down a little bit, driving up EPS a little bit more than earnings itself. So I would say, in general, I'm positive about the stock. I think great on the India infrastructure story, and we look forward to guidance to see how they're seeing the path going forward. And in general, I think election years are probably not great years because there'll be a suspension of activity for at least 3 or 4 months. But I would say that no matter what happens, whichever government comes, we'll have to focus on infra. We have the momentum going, and I think we should do the best of it no matter what happens.
Okay, I like how you're making the assumption on elections as well here, Deepak. But, Deepak, what manufacturing was for the last 2 years, you think it's energy transition or RE, which is going to be the theme, or would it continue to be manufacturing?
It's a good question. I think energy, so it'll be part of the whole cycle. There'll be parts of manufacturing, core manufacturing, whether it is semiconductors or some layer of assembly in that sense, auto. All of these, I think, are due for an upgrade in terms of whatever's happened in the past. The capex that is coming in now will probably reflect in the future. From an energy transition standpoint, it'll take some time before a lot of core activities change. So we've got some hydrogen plants and we've got some lithium-ion plants that are in progress. Nuclear power that has been announced. These are all long gestation, between 2 and 10 years. So you're going to take some time in getting those up and ready in place. So we'll still have to see some traditional energy continue to happen, whether it is coal or otherwise. Again, we've seen some really massive improvements in that space, both from the power production point of view and also from the fact that the financial stability in the power ecosystem is much better now than it has ever been in the past. I think commendable effort right now, I think, by the regulators and the government to ensure that players are compensated appropriately. So you're going to see this transition happen over 3-4 years. I think they'll both take parallel tracks. We're very gung-ho on manufacturing, not yet so gung-ho on energy transition as a play. But definitely energy is one part of our, a good part of our holdings. And I think they'll interplay with each other very well in the next decade at least.
Okay, so energy transition is, of course, the theme for the decade, not just 1 to 2 years. But talking a bit more immediate term, and that's, of course, Tata Consumers, which will come out with its earnings tomorrow. What the expectations are, Vinny is joining us to tell us all of that. Hi, Vinny.
So yes, in terms of numbers that we are expecting from Tata Consumers this time around, revenue is expected to see a growth of around 11%, coming in at 3,730 crores. Profits a slight bit of a decline of 7%. While in terms of the margins, we are expecting an expansion in terms of margins, almost 120 basis point expansion in terms of margins. EBITDA margins expected at 14%. What we are expecting is a mid-single-digit volume growth for the Indian beverage business as well as the food business. We are expecting the salt business to sustain a decent growth, mainly aided by pricing, but maybe the volumes could be a bit muted for the salt business, so keeping an eye out on that one. India tea business, that's a key one to watch out for as well. We're expecting a 4% volume growth in terms of that. Nourishco expected to see strong momentum coming in. Starbucks also, let's keep an eye out on commentary coming in on that front. International business is key to watch out for because we're expecting an improvement to start seeing in terms of the margins for the business as well in the international market. factors to watch out for, important to watch out for in terms of commentary that's there in the demand environment, out-of-home consumption, how has that recovered? Tea, coffee prices, key to watch out for because raw material prices, we've seen that sharp impact coming in before in the tea business of the company as well. And coffee prices because internationally the coffee prices were impacting them as well. And overall updates coming in on the international business front are key factors to watch out for.
Right. Deepak, is FMCG at large, and I'm not talking about ITC kind of conglomerate plays here, is that a passé theme now? Do you think there's, there are better ideas out there, and B, that whole disconnect between what urban and rural India is doing with inflation hitting hard, that's going to keep them at bay?
To some extent, yes, but this is an election year, so a lot of rural spending will happen in general. So I think there may be some kind of recovery in volumes, but I don't estimate this whole sector to grow at more than 10 to 12% per year in rupee terms overall, regardless of whether volumes grow or not. There's also the fact that they're very richly valued. So if you look at the stocks themselves, if they grow earnings by 10-12%, their P ratio will fall by a few basis points, and then that's enough to keep the stock price where it is. I personally think this is great for like a person who wants to hold for a 5-10 year period and get maybe a Nifty or a little bit more than Nifty kind of returns. But I would say these are not growth stories. They're more quality stories, so they're more ROE kind of businesses, and therefore provide a defensive outlook if you think the market is going to fall. So these become defensive plays right now. But again, I mean, defensive in the sense of their P ratios being so high, I'm sure some of them will also get battered. But I expect a lot of M&A activity in some of the plays here. So you're going to watch. I think we should watch for M&A activity to increase, and that's going to provide the kicker for those companies. I don't think with just organic growth, they are in very interesting in the long-term scheme of things, for me at least, because I like to buy stories that have stronger growth. These are good names, just not good enough for me right now.
But not good enough. That's the word coming in from Deepak Shenoy. On that note, we'll let you go. Deepak, thanks so much for joining in today. But if you look at the markets in the last 15-20 minutes, there has been a good recovery when it comes to the Bank Nifty, and that's where the maximum momentum has been. So let me take it across to Naresh to get a sense of as to what he's making of this move on Bank Nifty. Naresh?
So a strong move on Bank Nifty. We are seeing a good contribution coming even from names which were sluggish, something like a HDFC Bank and a Kotak Bank also bouncing. And more importantly, ICICI Bank is taking the lead in today's bounce. But overall, on the upside, we still have a lot of resistances going forward. So the target now would be closer to 43,500, which was the previous major support. So over that point where one could be looking at a pause coming around 43,500. So some more steam left from here.
So that's the take coming in as far as Bank Nifty is concerned. What else is happening in the market? Well, it's just the Bank Nifty actually a 300-point rally. Remember, for most part of the trading session, it was underperforming today. It was languishing in the red. But it's ICICI Bank, which is up a good 1.5%, HDFC Bank, Kotak Mahindra Bank. So all of these banks are participating. Even AU Small Finance Bank has managed to trim its losses from that 5-6% cut. It's now down to 3%. IDFC First Bank as well, at one point of time, it was staring at cuts of over 5%. That too has recovered from the lowest point of the trading session. But Naresh, given the kind of setup we are witnessing, any BTSC trade that you want to identify?
So looking at two mid-cap names as a bounce back trade. First is a buy on Tata Power, which has corrected quite a bit. Stop loss at 237, target price of 244. Second is a buy on RBL Bank, again corrected from 250 odd levels to 223 odd. Risk reward trade here, stop loss at 221, target price of 228.
Let's begin winding up for the day in that case. Let's check in on firstly what the new listing of the day is up to. Max Estates, given that it actually listed at a discount to its issue price. Let's see with the rest of the market recovery whether that's picked up. Not quite, 5% lower. Right now it listed at 298, 283 is where it's shutting shop for the day. Vodafone Idea, that's got to be one of the best performers in trade. That's been, quite the, surge today. 6.5% higher is where it's shutting shop in trade. Zydus Sun Pharma, they signed a licensing agreement for co-marketing of one of the drugs, which is used for the treatment of chronic kidney disease patients. Zydus Life was a mover to start off trade with. 1% higher is where it's shutting shop for the day. L&T, of course, you've got the numbers tomorrow, and L&T Construction bagged a sizable order in the range of about 2,500 to 5,000 crore rupees. So that's another stock which is in focus. And Z as well. While the stock surge ahead of the SAT hearing itself, SAT has set aside now the SEBI order versus Z's Puneet Goenka in a fund siphoning case. So, that is one more stock which is in focus, though it's given up most of its gains. Piramal Pharma, that was quite the turnaround quarter actually that they posted this time around. The stock jumped up quite a fair bit, still going home with decent gains, about 3%. It's where is shutting shop in trade. Of course, tomorrow we'll have all eyes on L&T. Today you've got Marico, which is going to be reporting its numbers. And let's check in on KPIT. That's got to be quite the star performer. They've raised their constant currency revenue growth outlook for FY24 to now 37%. The stock closes in with a 5% gain, 0.5% higher for the Nifty, and good recovery for the broader markets as well. That's pretty much all the time on this edition of Closing Trades. Thanks for watching.